Welcome to the most important hour in radio. I am your host, investment advisor Sam DeGreen, and this is Freedom Through Finance, broadcasting from the intergalactic headquarters of Arizona's trusted fiduciary, fee-only investment advisor, DeGreen Private Wealth, located at the beautiful Scottsdale Professional Building, you guessed it, in Scottsdale, on Raintree and North 87th Street. You know the rules. Investing involves risk, and we are not affiliated with other radio advisors. Let's get started.
Correct. All right. Welcome, folks. Welcome. I am investment advisor Sam DeGreen. As you just heard, coming to you live, as always, from the intergalactic headquarters of DeGreen Private Wealth at the beautiful Scottsdale Professional Center in, yes, of course, you guessed it, Scottsdale. We have quite a show. I don't know why I said we. It's just me. I've got a big show today, and it's dedicated primarily to what I believe is going to be one of the primary drivers of market growth over at least the next decade, should this go into effect. And I am, of course, talking about the big, beautiful tax bill. Now, in all fairness, I did a pretty deep dive on it. We're going to go through all the major provisions of it and, of course, discuss what it means for you, because there's really, in this bill, there is something for everybody, and I haven't seen or heard anybody break it down just yet. Now, you may have heard an update that it stalled, that it has failed. Look, I'm still optimistic about the prospects of us receiving a tax bill this year, and actually relatively soon. They're going to the Republicans are going to rework this thing over the weekend, and I would expect that by next week, it's probably going to be up for a vote in the House, or at least close to. It doesn't sound like there's too much opposition, but the things that are holding the bill up, however, which we will talk about, they're big points. They're big points, and there's a lot of things to discuss with it. But first and foremost, as you know, this show is about investing. It's about you. It's about how we can help you here at DeGreen Private Wealth grow your portfolio for retirement, help you prepare for retirement, and everything in between. I want to encourage you. Look, markets are great right now. In case you missed it, the recovery for markets after April's steep sell-off has been nothing short of spectacular. In fact, all the major indices are now positive for the year, with the exception of the NASDAQ. The NASDAQ is only down 0.5 percentage point. 1 or 2 positive days, it's break even. Easy. So in my opinion, though, the speed of that recovery highlights the points I've been trying to make all along for the last few months. We are in the early innings of the next great American bull market. There is still so much to be optimistic about. The fact that that markets recovered so quickly once we received clarity on the trade news, and the swiftness in which it occurred tells me that, yes, of course, trade was a huge thing, but there was a lot more to be optimistic about than there was ever to be pessimistic about. The trade disputes obviously were a big thing. We needed to get through them. We are not out of the woods, though, yet. We're not. We're not there just yet. Again, the halt that we've currently are in when did it start? 2 weeks ago? A 90-day tariff halt. So we're not out of the woods yet. Tariffs are only temporarily halted, which again, I will take it. But now is not the time to get complacent. No. Now is the time to take action. And while this show is for everybody, our investment program of low cost, highly tax efficient, highly diversified, exchange-traded funds. This show is for everybody. This show is for everybody, and our investment program is limited to those with a portfolio of at least $500,000. If you qualify, I want to encourage you to give us a call at 480-771-7000. That's 480-771-7000. Or you can visit our big, beautiful website, DeGreenPrivateWealth.com. That's DEGREEN, privatewealth.com. And I understand it. That phone can get heavy sometimes. So it's easier just to fill out a contact form. When you fill out that form, we will reach out to you. But of course, the easiest way is to give us a call at 480-771-7000. Let's not forget the lessons that we learned in April, which is that markets can turn on a dime. Yes, things can be going great, but suddenly they can change. Now, I'm not predicting that to happen right now, but I would be negligent in my duties to you if I said it can't happen. Of course it can happen, and it likely will happen again. Right now, all the pleasantries are being exchanged between China and the United States. If it were that easy, it would have been done by now. China is America's adversary. We can sign all the deals we want, but what it's going to come down to, and where things might get difficult, is the enforcement mechanisms. That's going to be key to working with China. We can have all the rules in the world, but if there is no enforcement mechanism, China's a no-go. One of the things we do in our portfolio is we try to limit exposure to China as significantly as possible. Now, look, it's the second largest economy in the world. There's 1 billion consumers. You cannot throw a rock without hitting a company that has exposure to China. But when it comes to going out of our way to get direct exposure as opposed to indirect, that is what we aim for. Anything we can do to keep the Communist Party out of your portfolio, we absolutely will do, because it turns out communist countries and economic growth, it's not really a good combination. It never is. But of course, they've never tried communism, as you know. I never understand it when people say that line. Well, it's never really been tried, or that it's when they tell you it's a good idea on paper. No, it's not. It sounds like hell on earth, even on paper. You can say it out loud, it sounds bad. When I read it on paper, it's even worse. Anyway, folks, we are on the ground floor of the next great American bull market. There is so much room to run here in this tax bill when it does get passed. And despite the failure on Friday to leave the committee, I'm encouraged. I am very, very encouraged by it. So I think we're going to get past the differences. There's no doubt there's going to be some grandstanders. But I think everybody, for the most part, seems to be on the same page when it comes to passing tax cuts. Very, very, very encouraging to hear. What you need to know, though, too, is that this week, a deal between the U.S. and China was announced. And as a result, the major U.S. benchmarks made up all of their losses since Trump's April 2nd tariff announcement, which led, incidentally, to a brief dip into bear market territory. It's where we see a decline of 20% from market peaks. Month to date, incidentally, the index has gained about 7%. So the day after the twins were born, yes, my twins, as I've told you before, every time I have a child, the preceding 12 months in the S&P 500, at least 20%. And we're already halfway there. Is it because I had 2 children that we might see a 40% return? I don't know. Maybe it cancels out. But so far, so good. The prophecy, as foretold by me on this show, seems to be playing out. Anyway, 7% up month to date. Excellent. And according to my research, about 60% of those gains can be attributed to big tech. So you think the Magnificent Seven, the NVIDIA, the Tesla, those are up 24% just this month. Meta Platforms, Microsoft up 16 and 15% respectively. And Amazon up 11%. We have not seen a lot of moves from Amazon. So again, very, very encouraging. And I'm very optimistic about the future. The market rally, though, is broad. Now, it's not uncommon for the top holdings of an index to drive market performance, but I'm encouraged by what we're seeing. Again, only 60% of market movements have been attributed to big tech, which means the rest of the sectors, those that do not have as large a weighting in our major indices, like technology, are pulling their weight. That's a healthy market. That is a healthy recovery, which tells me there is more upside and that there is plenty of more room to run. If you are in a portfolio that you feel is not serving your best interest, or if you feel that your advisor is asleep at the wheel and they cannot afford to be, especially this year and especially over the coming years, there's going to be quite a bit of change as we've seen. Look, it's only been, 120 days Trump's been in office? And think of, my goodness, look at all the things that man has done. So now is not the time to sit on the sidelines and wait and just don't overthink it. It's time to get allocated. It's time to make some money because there is opportunity out there. I am telling you, it has never been a better time to be invested. I want to encourage you to give us a call, 480-771-7000. That's 480-771-7000. Let's get you properly allocated. Let's make sure that your portfolio is appropriate for you and that the level of volatility that you are in is appropriate given your individual goals and circumstances. And let's make sure that you get to enjoy the next leg of this bull market. And I believe investors will be paid handsomely for having partaken in it. I have to take a quick break here, though, folks, but when we come back, a little bit more on markets, and then, of course, we're going to talk about the big, beautiful tax bill. There is a lot to cover here, and I'm looking forward to it. You should, too, because we're all getting a tax cut, apparently, which is awesome. Anyway, one last time, 480-771-7000. That's 480-771-7000. Again, while this show is for everybody, our investment program is limited to those with a portfolio of at least $500,000. If you qualify, do not hesitate to reach out. All right, welcome back, folks. Welcome back. I am investment advisor Sam DeGreen. Look, one of the things that we're seeing here with this economic recovery, not even economic, but with this market recovery. Again, I think many of the fears that people had about markets just 2 to 3 weeks ago, where everybody was calling a recession. I'm getting alerts on my phone from every single major brokerage. Oh, this so-and-so predicts a recession. So-and-so predicts this. So-and-so predicts that. Now, of course, I don't receive those. Interesting how that happens. Whenever things start to get rough, that is when the doom and gloom crowd comes out, and they, again, never really make things better, but that's okay. They're trying their best to push markets down even further, but it's not working. And the reason being, there is too much in this market to be optimistic about. Again, I am very encouraged by the broad rally that we are seeing in the United States, and it is across all of the major indices in the United States, primarily NASDAQ, the Russell. We're starting to see a lot of movement there. We're starting to see a lot of movement in the S&P 500, and it's not just concentrated inside of the technology stocks or the Magnificent Seven. In fact, about 40% of it is everything but big tech moving up, which is phenomenal. That tells me we're in a healthy market. It tells me there's a broad sentiment shift as opposed to just a small one amongst a few large companies. There's a large sentiment shift. And when that happens, look out. Just as sentiment can change and go primarily to the downside, and we saw just how fast that can occur in April, the opposite is true as well. When sentiment becomes positive, things move, and they move quickly. So again, very, very optimistic about markets. If you are in cash, if you are not confident that your portfolio or your advisor is adequately addressing your needs or has not been adequately addressing your needs, I want you to reach out to 480-771-7000. That's 480-771-7000. Again, we are not out of the woods yet. As you know, it's just a 90-day trade pause. But for the time being, when the seas are calm, now is an excellent time to make that switch, to be allocated, and frankly, to know, number one, your advisor has your back, and to sleep well at night. That is ultimately what retirement is going to be about, sleeping well at night. I've never heard anybody say, oh, man, I can't get any sleep in retirement. Haven't heard that one yet. But I have heard it when markets are down. So again, that's the only thing that can stop you from getting a good night's sleep. We don't want that. We want you to prosper, not just for the months ahead, but for the years ahead, because as I've told you before, and as I'm going to state again, we are on the ground floor of the next great American bull market, and you deserve to partake in it. Now, another thing. Trump announced on Friday that his administration will send out letters to countries in the next 2 to 3 weeks that detail what they will be paying in terms of tariffs to do business with the United States. Trump has also hinted that agreements with South Korea, India, and Japan could be coming very shortly. That would be huge. South Korea and Japan, obviously big exporters of technology, and there, a lot of U.S. companies, in fact, a lot of U.S. insurance companies do business in Japan. But what's significant about that is it adds just more clarity. Again, markets can handle bad news. Markets thrive on that clarity. Even if the picture isn't pretty, if the picture is clear, things become significantly easier to navigate. Another reason to stay invested. You have to remember, too, market movements do not come incrementally or every day a little up, a little up, a little up. No, they come in spurts. So we want you to remain properly allocated so when that time comes, you can take advantage of that upside. And when the opposite happens, that you are protected on the downside, that you are allocated appropriately so that your portfolio can slingshot back and start recovering quickly. One of the things that our DeGreen EMA portfolios that I absolutely love, you'll get people that say, well, just buy the S&P 500. And for a while, when you're young, maybe you're 30 or so, that works. But after a certain point, when you're nearing retirement, if we went through another 2008, and again, I'm not predicting anything like that, but when markets decline, like they did in 2008, it took the S&P a very long time to break even. It took our most aggressive portfolio, the most aggressive portfolio we have, less than 2 calendar years to get back to break even during 2008. And this isn't something that was back tested. This is something that happened. That's significant. So we've watched our portfolios over more than 20 years, in fact, for some of them. Long-term volatility and performance track records, That makes a world of difference. So you don't have to look back and guess on how how your portfolio may react. We can look back at that performance. Now, as you know, I can never guarantee performance legally, and I wouldn't. But the past really does give you a pretty good indication of what you can expect. It's never going to play out the same way, but it does give you a good indication. So again, if it took the S&P 500 5.25 years to get back to break even, that changes everything in terms of retirement. If you retire right during 2008, you're in trouble. Those first few years of retirement are crucial. Number one, that's going to be when you're spending the most. That's going to be when you're going on those trips. Having you take withdrawals from your portfolio during that time, or having to wait 5.25 years if you were to own the S&P 500 only, when you retire, to get back to break even, that puts your entire retirement in jeopardy. Timing sometimes does not go people's way. And that is why it is so crucial to make sure that your portfolio can return to break even quickly. And that is just one of the many, many attributes of our low cost, highly tax efficient exchange traded fund portfolios that we employ here at DeGreen Private Wealth. Now, while this show is for everybody, I do encourage you, if you meet our $500,000 investment minimum, I encourage you, give us a call at 480-771-7000. That's 480-771-7000. Or you can visit our website, DeGreenPrivateWealth.com. That is DeGreen privatewealth.com. On that beautiful website, you will be able to see all of our most recent past shows, including the one last week and the week before and the week before and so on. We are also on Spotify. We are on YouTube on Freedom Through Finance. You can find that on our website as well, where you can listen to the shows. And on top of that is our contact form. As if it didn't get any better, our contact form. You go, oh my gosh, I absolutely love what Sam's saying. I need to reach out to him because I need to invest prudently. There it is, the contact form. Folks, it has never been a better time to be an investor. Never been a better time to be in investor. Markets are highly capitalized. We have so many different tax law changes, beneficial tax law changes coming. We have a pro-business president. We have so many different things that will serve us well as investors. And they're already taking place, many of them, and some of them are on the horizon. Let's make some money. And if you were sitting in cash, maybe you got a little nervous in April, maybe you just didn't get back in, maybe after 2022. Whatever the case may be, maybe you just inherited some money, you don't know what to do. We're here to help. And it all starts with our serious one-on-one diagnostic interview to determine if what we do here at DeGreen Private Wealth is right for you. And if it is, which one of our carefully risk-adjusted, carefully crafted portfolios is going to best serve you and your family for the months and years ahead. It is a privilege. It is an honor, and truly it is. It is so much fun to meet with people each and every week. I absolutely love it. Our number, 480-771-7000. That's 480-771-7000. Got to take a quick break. And again, we will be touching on that big old tax bill coming up. I am investment advisor Sam DeGreen on News Talk 550 KFYI. We mentioned last week about hard and soft data. We discussed that. That's going to be particularly important. Now, the hard data, this is what you see on earnings calls. This is really the most important type of data. Soft data is the sentiment indicators, the things like the CNN Fear and Greed Index, which again, the only valuable thing CNN has ever produced. all of these, the manufacturing index, all of the things that measure investor sentiment. Sentiment has been terrible. April's consumer sentiment, for example, dropped to its second lowest on record. Now, who has the lowest? His name is Joe Biden. Trump's declined rapidly in April as everybody started to panic about the tariffs. Of course, much of that has turned around recently. So soft data is not something you want to rely on, but hard data, the earnings calls, the actual quantitative measurements, that's what we want to focus on. Retailers like Home Depot and Target are set to report earnings Tuesday and Wednesday. I believe Walmart as well. Target is one of the companies that has said, "Hey, we're going to increase the costs of many of our products." They have about 30% of its imports coming from China. They've warned that they're going to raise prices. Walmart warned on Thursday of this week that they're going to start price hikes. Perhaps later this month, Mattel, another one, has said that it will increase prices as a result of tariffs. Now, my question is, well, if tariffs right now are suspended, why are we getting price? I understand they rose a little bit, but why are we getting price increases now? Somebody's lying. I would love to see the Republicans call these companies out and say, no, knock it off. Knock it off. Eat the cost right now. Eat it. I know that's a very, I don't even like telling companies how to run their businesses. I don't. I wouldn't want someone doing that here. You wouldn't want someone doing that to you, but they're ripping us off. They're absolutely ripping us off. Anyway, hope the Republicans can call them out. Another big thing, speaking of Republicans, tax cuts. That's right. Good old-fashioned tax cuts. The ones I actually was starting to worry about. Well, we got a lot of updates here, and it does appear that we have a 1,116-page bill, officially known as the One Big Beautiful Bill Act. I absolutely love the name of it. It failed on Friday to advance through the House Budget Committee. Now, the good news is that was the final hurdle before there is a full vote on the floor. It does appear that we're going to have the votes to get it done. There's going to need to be a few more tweaks, though, and we'll discuss what those tweaks look like. Obviously, let's hope that the Republicans can pull it together, but I think there is enough broad support that we should be able to get it done. So I went through this bill. I did as much reading on it as I humanly could. I went through it. Right now, there's about 18 major things, major changes that you will see. And let's just go through them. We'll just go through them point by point. First of all, no tax on tips. Is that in the bill? Yes, it is. It is in the One Big Beautiful Bill. Here we go. The no tax on tips. How would that work? Well, the proposal would establish a temporary tax deduction equal to the amount of qualified tips received during the year through 2028. The Secretary will publish a list of occupations that traditionally and customarily receive tips that receive tips that will qualify for the deduction. So they will release further guidance on this, but it does appear that is going to make it into the bill, the no tax on tips, which I think is excellent. But the only problem I have with it, and again, there's going to be some of these where I'm going to sound like a negative Nancy. I'm not trying to be a negative Nancy. I'm trying to be a I can't think of anything, something Sam, but you get the point. I love it. Anytime we can reduce taxes, I'm all for it. But why on earth are we putting a sunset provision on the no tax on tips? What is the point of doing that? Who's going to say, you know what, I can't vote for no tax on tips for the rest of my days? Can't do it. Can't do it. Nobody. That's who. So again, this is one of those things where Republicans, I don't understand why we are inserting sunset provisions onto a tax change that everybody seems to be for, and there's no reason. I guess it would be for political purposes, given that it ends in 2028. People start paying taxes on tips. But they're missing the Republicans here, especially those that are saying, oh, well, look, our big hang-ups here, that it doesn't reduce federal spending, it doesn't address the debt. This is how you grow your tax base. When people have more money, they buy more things. That helps. They start businesses. They do things. They spend. They save. Whatever it is. But the fact is that money gets allocated efficiently. It grows. You broaden your tax base when people get to keep more of their money. Time and time and time and time and time. Again, this has been proven to be the case. So for, again, the Republicans to sunset anything at this point when they're not required to, why? Why are we doing that? Now, would this be a break it for me? No, not at all. But it is something nonetheless that is very frustrating. Now, there's no tax on overtime. Another thing. The proposal establishes a deduction equal to the qualified overtime received during the year through, again, 2028. Qualified overtime is defined as overtime compensation paid under the Section 7 of the Fair Labor Standards Acts of 1938. Employees are required to include overtime on the W-2 exclusion. So, again, I am all for it. I am all for people keeping more of the money that they make. Why are we imposing limitations? Why are we imposing sunset provisions on something like overtime? That's the type of behavior that we want to reward. We want to reward hard work. We want to reward people who do take $2.50 an hour because they know they will make it in tips, or they hope to make it back with tips. I don't understand it. Again, why not make it permanent? Next one. Deductions for seniors beginning in 2025 through 2028. This one gets me going. The standard deduction, and by all accounts, this is not going to change. And again, that's fine. I'm all for people keeping their own money. But why? I would ask. What is the purpose of doing this? I think this is going to be we couldn't get no taxes on Social Security. However, this is going to be, I believe, kind of the backdoor way of getting it. The standard deduction is increased by $4,000 for individuals age 65 or over, even if itemizing. So, if gross income exceeds $75,000 or $150,000 for married couples, the deduction is phased out by 4% for every $1 over the threshold. In other words, it phases out pretty quickly. Very quickly, actually. So it really is, it's for people making less than $150,000 once they are aged 65, which is a huge portion of the Social Security population. Most people will take Social Security around that age. most people today who have not taken Social Security, well, frankly, everybody's full retirement age is at 67. So, again, that's what I think this deduction is there for. So here's the way it would look like. For 2025, the standard deduction amount is going to be $30,000 for a married couple. So married seniors would get a deduction of $30,000 plus $4,000 for each of them, so for $8,000 in total. You get a $38,000 essentially standard deduction. The way this works is it comes out to this: $16,682 for federal income tax. Arizona state income tax would be $3,000. So your total tax bill, and this is before we include the $4,000 for individuals age 65, is going to be $19,702. That is as it currently stands now. If this tax bill passes, somebody with a gross income, a married couple, with a gross income of $150,000 would receive a standard deduction of $38,000, making their taxable income around $112,000, which means their federal taxes would go down to $14,746. Their Arizona state tax would be $2,800, and their total tax liability would be $17,546. That is $2,156 saved in taxes each year for people over the age of 65. So it is essentially will save you upwards of $2,156 at the maximum if you're making right on $150,000. Given that the maximum you can really earn on Social Security for I believe is about $4,100. That's if you get the catch-up contribution, or not the catch-up, but the 8% increase each year. When you look at the average amount of Social Security, I think this is pretty close. Most people probably going to get about $20,000 or so dollars a year. That's 10%. So really, that's about what the standard person or the average person probably pays in Social Security taxes each year, about $2,156. That would be my guess. That's the way they came up with these numbers. Now, I truthfully, on its face, I don't think this is what the tax code is for. This is more of a demo. I know most of you are screaming at me probably right now. What do you mean, Sam? What do you mean? Again, I'm okay with it. I'm not gonna break down over it, and I'm not gonna lose any sleep over it, because it's ultimately your money. People should get to keep their money. But what I don't understand is why are you receiving an extra standard deduction because you made it to old age? I understand why there'd be no tax on overtime and no tax on tips. That's that's earned income. That's work. But even if you're not taking Social Security, you still get a $4,000 deduction if you are over the age of 65. If you're a married couple that is over the age of 65, you get $8,000. How does that make any sense? That's a giveaway. I guess I'm fine with it, but I don't get it. Anyway, all right. I'm going to take a quick break here, though, and we'll get into some more of these because, frankly, folks, there is a lot to cover. But again, while this show is for everybody, our investment program is limited to those with a portfolio of at least $500,000. And I know we're talking about taxes today, but that is because taxes is going to be the fuel that this big, beautiful bull market continues to run on. So, of course, we have to discuss it and what it will look like for you when in retirement. Again, taxes doesn't stop when you retire, unfortunately. Your income might go lower, but taxes is still a problem. And that is one of the things that we will address during our one-on-one investment suitability interview. We'll discuss the order of withdrawals, how best to sell off securities if need be in order to reallocate them more effectively. But ultimately, I encourage you to give us a call, 480-771-7000. And while this show is for everybody, our investment program is limited to those with a portfolio of at least $500,000. If you qualify, don't hesitate to reach out. Please don't hesitate to visit our website, DeGreenPrivateWealth.com. That's DEGREEN, privatewealth.com. And on that website, you will be able to find our contact form and all of our most recent past shows posted there as well. You can also find them on our YouTube Freedom Through Finance page. Something we've started and something that I've neglected to talk about, and I'd like to start driving people there because, of course, it's always great to listen to shows on demand. Because, again, life sometimes gets in the way, but you don't want to miss this program. One more time, 480-771-7000. Give us a call. Let's make some money. Let's get you properly allocated. Let's have some fun, too. All right. Back in a moment, I am investment advisor Sam DeGreen on News Talk 550 KFYI. We are back. I am investment advisor Sam DeGreen. You know, I was walking on the beach, and I saw this beautiful group of seashells. I can't even get past. I saw a beautiful group of seashells, and they spelled out the number 480-771-7000. I just thought it was a really unique pattern. Totally unique. Just totally didn't place them there by myself. 480-771-7000. How stupid does James Comey think we are? Why on earth would you post that? Look, I'm not saying I hope the Secret Service roughs him up a little bit. I think that's perfectly fair, given all of the trouble that he's put everybody through. I think maybe a minute or two of roughhousing. That's the way we're going to classify this. Of roughhousing by the Secret Service. I think it's fair. I think that's fair. But he is such a weasel. My goodness. First of all, what grown man is playing with seashells on the beach? And second of all, a grown man playing with seashells on the beach decides to take a picture of them like a 15-year-old girl on Snapchat or whatever, Instagram, and he makes it political. What a dork. What a complete fruit. I mean, my goodness. A grown man playing with seashells on the beach threatens the president with a... It's so ridiculous. It is ridiculous, but I'll tell you what's not ridiculous. I'll tell you what is ridiculous. Mutual funds. If you own mutual funds, I've extended this offer before, excuse me. If you're not sure whether or not your advisor has your best interest at heart, what I want to encourage you to do is visit, you can either visit our website or email me, sam@degreenwealth.com, or give us a call at 480-771-7000. And what I'm happy to do is take a look at your portfolio for you. Again, free of cost. I'm happy to do it. Now, while we're doing this for people with an investment portfolio of at least $500,000, but I'm more than happy to take a look and say, okay, can this be done better? Should it be done better? Where are the strengths? Where are the weaknesses? How much are the fees that you are paying? One of the things that people are shocked about is how much they are paying to mutual funds each and every year. You will never, ever see those expenses listed out on a statement. They are taken right off the top. And they can cost you another 1% each year. So if you're paying an advisor 1% and you're paying mutual fund fees, you're paying 2% each year on $1 million. That's a significant amount. It's $20,000. Yikes. You thought you were paying 10. No. So again, those are the types of things, folks. We keep our internal costs for our portfolios. 10 to 25 times less expensive than the average mutual fund. I believe ours currently is about 8 basis points right now. That's 0.08 of 1%, whereas a mutual fund portfolio will cost you about 1%. That is a massive difference, and it is something that when you make the switch to a low-cost ETF portfolio like those employed here at DeGreen Private Wealth, you're going to see an immediate, number one, savings, and you're going to see a better return. Turns out, when there's more money working for you, you do better, which is better for everybody. So I don't know why it continues on, but if you're not sure whether you own a mutual fund, remember, X marks the spot. When you look at your ticker, that is not your heart, but your the 4 or 5 letter abbreviation right next to the fund name. So it could be ABCDX, SAMX. It could be, you get the point. When you see it, if you see something ending in the letter X, you should be alarmed, and you should call me at 480-771-7000. That's 480-771-7000. I'm happy to take a look at it, and I'm happy to offer you any suggestions or provide you a way in which we can help. Our number, again, while this show is for everybody, our investment program is limited to those with a portfolio of at least $500,000. If you qualify, give us a call, 480-771-7000. That's 480-771-7000. You can also visit our website, DeGreenPrivateWealth.com. That's DEGREEN privatewealth.com. And on that beautiful website is our beautiful contact form, where I understand sometimes people don't want to dial. They don't want to pick up the phone. They say, you know what, I know this is important to me. Maybe it's really late at night. You're sitting up looking at the ceiling going, oh my gosh, I'm about to retire here very, very soon. This is not good. My advisor hasn't called me in 2 years. I think my advisor knows my name. I'm not quite sure. I need to do something different. If that sounds like you need to give us a call, 480-771-7000. Or, again, you're sitting up late at night and you go, I need to contact DeGreen Private Wealth. And on that beautiful website, DeGreenPrivateWealth.com, is our contact form. And all of our most recent shows are posted there, and they are posted on the Freedom Through Finance YouTube page, and they will be there going forward as well. So remember, you can always listen to us on YouTube, Spotify, wherever it is you listen to podcasts. But most importantly, you want to catch us live, because you just never know what's going to happen here on terrestrial radio. All right. Back in a moment. We got hour number 2 coming up. I am investment advisor Sam DeGreen on Newstalk 550 KFYI. Folks, welcome back. I am investment advisor Sam DeGreen. I just had somebody. I haven't double checked the math on this one, but it's going to be weird. If there's a conspiracy theory, this one is probably it. 8647. The day that was posted was exactly the number of days from 9/11. That's odd, if that's the case. And I'm rough mathing it there, but I think that's probably pretty close to the number of days, which is, conspiracy theories. Anyway, it's probably more likely that the FBI director was just playing with seashells on the beach like a complete and utter fruit. Anyway, all right, we're talking about the new, big, beautiful tax bill that is coming out. All righty. 1,116 pages. It failed to get out of the House Budget Committee on Friday. However, it does not appear, at least the ones that we've gone over, some of the provisions here that we've gone over, that many of these are going to be on their way out. What appears is that right now there's a log jam, or at least not enough support to get it out of committee, primarily because many House Republicans think it does not go far enough in terms of Medicare cuts, and I know SNAP spending is another one, the Supplemental Nutrition Assistance Program, and the Green New Deal stuff. There's a lot of energy credits that are going to be phased out slowly, whereas many people want them cut out over time. So far, what's in the bill right now, and these are the things that I have not heard actually anybody really raise any concerns about. It's possible that maybe some of these won't make it into the final draft, but I haven't heard anybody argue against these yet. So here's what they are so far. No tax on tips. That is in there, but it is only through 2028. There's no tax on overtime. That is in the big, beautiful bill. Again, it's another provision that is unnecessarily, in my opinion, sunsetted. Then there is the age 65, the sweet, sweet $4,000 deduction that you get for being alive at the age of 65. At age 65, even if you are not itemizing your deductions, you are eligible to add on top of the standard deduction, which for this year will be $30,000. You are eligible for $4,000 per person. So if you're married, that's $8,000 in total. You'll get a $38,000 deduction, as opposed to the standard $30,000 this year. That results in a savings, and I'm using Arizona state tax here too. That results in a savings of about $2,156 per family over the age of 65. I'm not, again, I've stated my issue with them. I'll state it one last time and then I'll move on. But I do not think you should get a tax deduction specifically because you hit a certain age. The whole purpose of taxes is to incentivize work. Is to incentivize people to do things. So I guess if you want to incentivize people to keep living, that's one thing. I don't think that's ever really been a problem. But no tax on overtime, that's a person's work. That's a person's time that they've invested and earned income. Then you have no tax on tips. Again, that goes back to, first of all, I think it helps a lot when it comes to making it significantly more advantageous for employers. And again, it's another carve out for a group that is working. But if you're 65, I'm not exactly sure why we're giving another $4,000 deduction if you're over 65. My guess is that's because the no taxes on Social Security did not make it into the bill. I didn't think it was likely in the first place, but I guarantee you, the more that I think about it, I guarantee you this is essentially a backdoor way for the no tax on Social Security. So if you're taking it at 62, okay, you're going to get taxed on that amount. But at age 65, that $4,000 deduction should offset a big portion, at least, of that taxes on your Social Security. All right. Then there is the no tax on cars loan interest. I'm not sure who asked for this one. I think it was Trump who threw this one out there. If this one gets nixed from the final bill, I wouldn't necessarily be surprised. So it would be a vehicle interest deduction with a $10,000 limit. So if gross income exceeds $100,000, $200,000 if married filing jointly, which is very generous. The loan interest is phased out, $200 for every $1,000 over the limit. That's another very generous another very, very generous thing. So there's a few things. Number one, final assembly of the vehicle must be in the United States. That is one of the provisions. The vehicle that you are using must be finalized in the United States. There's a few exceptions. Commercial vehicles, that's not one of them. Loan to finance fleets, those are not available. And my understanding, though, is, again, this would apply to everybody, whether or not you itemize deductions or not. And I actually don't necessarily have a problem with this if we can, number one, sell more cars. And with rates being where they are, that would actually be a pretty significant help for a lot of people, because car financing is absolutely crazy right now. Rates are coming down, but still. Then, I had not heard about this one. There's the number 5. This is the MAGA account. This establishes a money account for growth and advancement. That's what it's called, Money Account for Growth and Advancement, MAGA, which is an investment account for children to pay for higher education, small business loan related expenses, first home buyer costs. I actually really, really, really like this. Before I get into that, let me give you some rules on it. The beneficiary must be under the age of 18 at the time the contribution is made, and under 8 at the time the account is established. So, that is interesting. But at the same time, great. The contribution limit is $5,000, no withdrawals before age 18, and the account must cease to exist by the time the beneficiary is age 31. I like this one. Number 1, I don't like the idea of saving for college. I would much rather help my children with a down payment on their first home. Now, I have a feeling I'm going to get stuck and have to do both, plus pay for weddings for the 3 girls and everything. Oh, twins, I'll tell you. Anyway, sorry, I was getting flashbacks there of 4 kids at the house. Beneficiaries. So again, I like this. I do like this a lot. I think it's a good thing for parents to be able to put some more money away for their kids' future that's not specifically school related. We have 529s for those. Incidentally, if you have a child or a grandkid, you can get a $4,000 deduction for contributing $4,000, but no more than $4,000 to your to a beneficiary's 529. So for each kid, for example, for my 4 children, if I put $4,000 in for each of them, and believe me, that is all they are going to get, $4,000, that's $16,000 deduction, assuming I still have the money. But that's great. So that is something you can currently do, and I do like the idea of the contribution limit being $5,000. I think that's a nice chunk, and I also really do enjoy that it is for small business loans too, because not everybody is meant to go to college. In fact, if you're going to trade schools, you're probably going to end up better off over the long run, especially at this point in time. And first-time home buyer costs, that is a massive one. This is where I feel Congress may have missed the mark, though. And I've talked about it on the show before. Currently, if you're single, $250,000, or if you're married filing jointly, in this case, it'd be $500,000. If you sell your house, you bought it for $250,000, you sell it for $750,000, and you're a married couple filing jointly, there's $500,000 of gains that is excluded from taxes, period. So you walk away $500,000 richer. I think those numbers need to be adjusted. They haven't been adjusted since the 90s. I think it should be $500,000 for single people, and I think it should be $1 million for those married filing jointly. The reason being is if we need to free up a lot, we need to allow people to downsize their homes in retirement. And again, many of the clients I talk to would. But the question is, well, where do I go? Well, this kind of fixes a lot of that, because you're going to walk away with a significant amount of money. And in places where housing shortages are the worst, that increased exclusion amount would be quite significant, and would free up homes for those who have young families and who are starting to grow. That's where I would start, honestly, and I think that's something they should throw into the provision. I can't imagine it would be any more costly than many of these other things, but I think it would be a huge help, and I think it would help housing come down, which would also bring down interest rates. Shelter costs are a huge portion of the inflation reading. They make up about a third. So if we see housing prices and shelter costs come down across the board, that lowers the Fed's preferred gauge of inflation, the PCE, and allows them to say, okay, inflation's coming down, now we can cut rates. So Trump wins in two big areas here. Number one, he makes housing more affordable, and number two, he knocks interest rates lower. So something that I would personally love to see. Okay, we got a couple more, but I have to take a quick break. Folks, again, while this show is for everybody, our investment program, I know I have an investment program. We haven't talked about it, but the reason being, folks, this is going to be the fuel that the bull market runs on. There are a number of provisions in here which I think are going to be significant in terms of GDP growth, in terms of not just GDP growth, but expanding the tax base as well. Hence why I'm very frustrated that the Republicans are sitting there worrying about, oh, does this increase the deficit? Does this do that? Don't worry about that now. Increase the tax base. Let people keep their money. Make sure that they feel secure. That's where you start. Worry about the other stuff later. Well, they go, well, we've worried about it later. No, you haven't worried about it later. You haven't done anything. Now that a Republican's in office, now you're going to start worrying about it. Worry about it when a Democrat's in office, like you always do, and maybe it'll get done eventually. But for now, focus on growing the tax base. Make as many people wealthy as you possibly can, and give people the feeling that they have something to lose in society, as opposed to just wanting more and more. Let them keep their money. It's theirs. It always has been. Anyway, before I get off track, 480-771-7000. That's 480-771-7000. Got to take a quick break. More on this when we come back. I am investment advisor Sam DeGreen on News Talk 550 KFYI. All right, welcome back, folks. Welcome back. I am investment advisor Sam DeGreen, and today we are talking about the big, beautiful tax bill that almost made it but didn't quite make it just yet. We're talking about some of the major provisions here inside of that bill, and there was quite a bit. Look, it's a 1,116 pages, but who's counting, page bill. There is quite a bit in it. So I went through it, got, in some cases, spark notes, because there's just no way I can sit through all of that. I'm human too. But yeah, there's a lot of good stuff. There's a lot of good stuff. There's a lot of stuff, some things I'd like to see better. A few things I think that are missing, but ultimately, I do think this is going to be tremendously beneficial, especially when you consider just how detrimental the Tax Cuts and Jobs Act, how devastating that would actually be if those tax cuts were to sunset. And they're set to expire at the end of this year, in which case everybody is going to feel it. One of the things that people forget about is that the standard deduction was nearly doubled with the Tax Cuts and Jobs Act. It's going to be cut in half. It's going to essentially go back to where it was prior to that, and yikes. It is not going to be a very, very beneficial one. And I think increasing the standard deduction, which many of these provisions in the tax bill do, I think is a good thing. There's a little bit of something for everybody. Now, here is the big one. This is also one of the hang-ups for the Republicans right now in the Budget Committee, who are currently arguing amongst themselves. Yikes. It is the state and local tax deduction, the SALT deduction. Now, if you don't know, There is a group of Republicans who are in blue states who have already stated if the SALT deduction is not big enough, I've told you this, I ran on it, I'm not voting for any tax bill or tax cut or whatever it is that doesn't address this. Currently, the SALT deduction limit is $10,000. You can deduct state and local income taxes up to $10,000. They want that to go to $30,000. Yeah, that's a pretty big jump. For $15,000 for married filing jointly, or for married filing separately, excuse me, and that would be up from $5,000. So there would be, it's essentially everybody's getting 3 times the amount of state and local tax deduction are eligible for it if you itemize. If gross income, though, exceeds $400,000, that cap is reduced by 20% of the income above these thresholds, but not below $10,000 or $5,000. So here's my take on this. Give the blue state or Republicans whatever it is they want. This is bigger than just us subsidizing blue states. This is about keeping red states red. And I don't understand why we don't talk about this more often, but there's a reason. These people from California are coming to Arizona, coming to Texas, coming to all of the the United States' most beautiful places and destroying them. And that is because they think taxes are too high. Now, they'll never understand. You'll never get them to understand that it was actually their own damn fault. That's why their state is on fire. That's why the state in which they left is a terrible place to live, is because you lived there. That's why it's terrible. You will not get those people to ever understand that. They're too clueless. You can't teach them anything. You can lead a horse to water. You can't make it drink or drown it in the sink or whatever the saying is. You cannot help those people. So the best thing you can do is contain them. The best thing you can do is contain those from blue states. Just give them all the tax incentives that they want so that they stay there. Stay there. Stop moving into red states. Number one, this affects our elections. When everybody's boasting about Texas and Florida's growing population, that makes me nervous. That makes me nervous. Because they're all coming from high tax blue states, and primarily much of that migration started after the state and local tax deduction cap, the SALT cap, went into effect. So if we want to make sure that Arizona stays red, and it should be red, always red, and Texas stays red, and Florida stays red, and every other place that is good on earth stays red, and that we stop receiving the fruits and nuts from California. Keep the they want $60,000. That is the coalition of these Republicans in Congress who currently represent blue states. They want $60,000 minimum state and local tax deduction. Give it to them. Give them $120,000. I don't care. Just give it to them so that you don't ruin the rest of the United States. That's the most important thing. We'll find other ways to pay for it, but keep our states red. But that is going to be a make or break issue, and I expect that number to increase in the final bill. Another thing, this was expected with the tax law. The extension of tax rates, the existing tax brackets of 10, 12, 22, 24, 32, 35, and 37 were originally scheduled to sunset in 2026, with the top rate reverting back to 39.6. The 12%, incidentally, goes to 15. The 10%, I believe, goes to 12. So it's everybody would get a tax increase. The new bill totally eliminates that, and it permanently locks in the current rates starting in 2026. There is no sunsetting on this provision, which means the tax cuts would be permanent. That is a big, big deal. That's also going to lead, for a while, everybody could bank on the tax cuts staying the same. But now, you bet people are not spending like they would, or they're not quite sure what their next move is going to be if they don't know what the tax liability is going to be when it comes to major spending. So getting this done now, I think, would also be beneficial for markets later on in the year. So I'm very, very pleased about that. In addition, there is a one-time $1,000 credit for each qualifying child born 2025 through 2028 deposited into the account of the the Make America Great Again account. The name escapes me here. It was, well, can't find it. Anyway, that's another big thing that I forgot to mention. Found out on the break. So, cool. $1,000 for each kid, and the tax rates are going to be locked in finally. That is a big, big deal. Again, I think it's good that the $1,000 credit for each qualifying child sunsets in 2028. I think that's a good thing too. Child tax credits. All right, there's going to be a change in the child tax credits. The child tax credit is set to temporarily increase from $2,000 to $2,500, woohoo, per child for the years 2025 through 2028. After 2028, the credit will return to the base amount of $2,000. Okay. Okay. I guess. The standard deduction. See, these are the types of things. The child tax credit is obviously helpful. Many people claim that. The additional $1,000, I think we could probably live without that one if it meant raising the state and local tax deduction. That would do more to get the bill through. And I imagine that might be one that's probably going to be on the chopping block. I got to take a quick break here, though, folks. We got a couple more provisions to go through when we come back, and we will discuss further what it is that's holding the Republicans back. Now, while it's only a few of them right now, they do represent different types of Republicans, and so surely these would have come up whether it made it through the House or not. So it's good to address these things now. Again, we'll discuss this more when we come back. 480-771-7000. That's 480-771-7000. Give us a call. Let's get you properly allocated. Let's get you invested. And I know we're talking about taxes today, not markets, but this is going to be a huge component of markets going forward. Stay tuned. I am investment advisor Sam DeGreen on News Talk 550 KFYI. Investment advisor Sam DeGreen. All right, for those of you just joining us, we're talking about some of the major the big, beautiful tax bill that is currently in committee. For those of you just joining us, let me give you a quick rundown. Here are the things that are in the final bill, not the final bill, but are in the bill so far that have not been taken out of it, nor do I think it's possible maybe one or two of these things gets modified. But ultimately, I don't think there's going to be any major changes from any of these provisions that I have listed here. If they are, maybe they're tamped down ever so slightly, but we will see. Number one, no tax on tips. That is in the bill. I haven't seen anybody raise any sort of fuss about that. No tax on overtime. The thing to note about both of these, no tax on tip, no tax on overtime, is that it expires in 2028. So it only lasts as long as Trump is president. Okay. Again, one of those things where I don't know why we're making it, why we're sunsetting it when nobody has a problem with it. Make it permanent. But I get it. It's about owning the Dems. The deduction for seniors beginning in 2025 through 2028. This is the no tax on Social Security. This is what they are calling it, the deduction for seniors. It comes out to, for a couple that's earning about $150,000, you get $4,000 for being 65 and older. You just get an extra $4,000 to add to your standard deduction if that's what you take each year. So that comes out to about $2,156, assuming you're making $150,000 on the dot. That gets phased out very, very quickly. So if you're making $160,000, I don't even think you're making anything, because it's phased out 4% for every $1 above the threshold, and that's based on your gross income. So, not your modified adjustment, but your gross income. There is the no tax on car loan interest. Okay, I'm for that. Gross income exceeds $100,000, $200,000 if married, filing jointly. The loan interest is phased out, and it's phased out pretty slowly. It's $200 for every $1,000 over the income limit. So you got quite a bit of room there before it's finally fully itemized out. Then you have the money account for growth and advancement. This is an interesting one because I had not heard about this one. This is for kids. Beneficiary must be under 18 at the time of the contribution and under 8 at the time the account is established. What does this account do? Well, it's for higher education, small business loans in the future, and first-time home buyer costs. I love that. I think planning for home ownership is one of the most important things you can do. I, in fact, would argue right now that it is probably a better investment than colleges. Truthfully, I know you have to have the stability and so on. I understand it's a little more complicated, but assuming your children get on their feet, and I have no reason to assume otherwise, that, and I don't know that you do either, you want them to get into a home. That is the quickest way to build wealth. Quickest way, it's basically a savings account. You can write off the interest. It's the way to do it. And of course, you're basically living rent-free, making all of the, and you're gaining home equity as well as benefiting from the appreciation in price. So again, I love that one. The account has to be closed at age 31 and no withdrawals before age 18. So great. State and local tax deduction, that's been tripled. So a big part of what we discussed last segment, huge problem with the current Tax Cuts and Jobs Act that was passed was the state and local tax deduction really, really angered blue state Republicans. I'm making the case that blue state Republicans should absolutely continue to scream about getting as much as they possibly can in terms of a deduction. That way, we stop having these crazy people from blue states move to our beautiful red states. Give them every tax incentive. Give the people in blue states every tax incentive to sit and live in the terrible paradise that they've created. Extension of tax rates. Finally, this bill makes them permanent. So it locks in the 10, 12, 22, 24, 32, 35, and 37% tax brackets. Excellent. Those were set to expire at the end of 2026. The standard deduction was set to be cut roughly in half starting in 2026, while the personal exemption was scheduled to return. The new bill eliminates that expiration, which means we get permanently higher standard deductions, and there's a temporary increase for 2025 and 2028 for personal exemptions, $1,000 for single, $2,000 for married. Next one. This is one that is going to start benefiting more and more people, and I absolutely adore this part of the plan. This is probably one of my favorite parts because I think it is the most underutilized account. If you are still working, you're maybe in your 50s, you're in your 40s, even if you're in your 60s and you plan on working for a while, make sure that you have an HSA account. If you have perfect insurance and everything's fine, great. But if you have an HSA, and you may have heard of them, max that sucker out every day of the week. It is the best, it is as beneficial, in my opinion, as a Roth. You get to use all of the funds for medical purposes. They come out tax-free. Then you get to deduct whatever you put in from your gross income, which is great. Another huge benefit. And if you do use it after the age of 65, you can also use it without being penalized. You just pay ordinary income tax on it like you would with an IRA. You can use it for living expenses. So it's an excellent, it's triple tax advantage. It is awesome. And the investments grow tax deferred, which is a huge thing. So expands HSA eligibility to individuals enrolled in Medicare Part A due to age. It expands the definition of a high deductible health plan to include bronze and catastrophic plans, which I will tell you is going to open the HSA market, which is going to cause the HSA market to boom. First of all, those plans are pretty terrible, and they're very, very expensive. I might as well have a high deductible health plan, but frankly, the math just doesn't make a lot of sense. I'd love to have my HSA back like I did a few years ago, but given some of the changes, it just financially didn't make sense for me to pay an outrageous premium for the privilege of paying another outrageous deduction, or outrageous amount of money just to say I have health insurance. It's a mess. But the HSAs, I cannot emphasize to you how important those will be on, especially for those of you who are 40 years old, 50 years old. Do not touch that money. If you can leave it alone as long as possible, that is going to be the biggest help in the world if you ever need nursing care down the road. And it's very likely that you will. That's just the reality of things. It's expensive. It's $5,000 to $6,000 a month to go into a retirement or a nursing home, a skilled care, whatever it is. It's about the same price, and it's expensive. So, something to keep in mind, having that available for when the time comes. Then there is, for us business owners out there, the qualified business income deduction. The proposal removes the expiration date of 2025, making the qualified business income deduction permanent. It also increases the deduction rate from 20 to 23% and revises certain eligibility limitations for SSTB income. So awesome. Like that one. 1099 limits. You'll like this. Many of you will like this. 1099K's limits, excuse me. So in 2022, the Democrats found out about the internet, and they said, oh my gosh, people are making money on this here internet, and people are making money selling things, their own things they've already paid taxes on. They're selling used stuff, and now we need to tax that because we need to spend it. So what they did was they said, okay, whereas you could sell $20,000 worth of stuff or 200 transactions, whichever one, 20,000 and 200 transactions, you could do that, and it would be basically excluded from income. You didn't even have to report it. PayPal didn't even have a mechanism to report it. Venmo didn't have it. Etsy didn't have it. That is a massive, that increased prices all over the place, especially for used things, because people would now have to report it as income. Well, it's not income. They're losing money on it, but if you don't have the receipt for the $50 pair of jeans you had that you sold for $25, you're getting to pay taxes on that $25. assuming you went over the $600 limit. So it went from $20,000 that you could make without limit to $600. And it was absurd. So the threshold now is the new limit would be $20,000 and 200 transactions. So additionally, the threshold for businesses making payments to other people would increase from 600 to 2,000 under that same rule. So again, it goes back to the way it should have been, which is a used market where you can actually get things cheaper, much cheaper on the internet. Now, for those of you who may use Etsy or some similar program, Reverb.com is one of them. It's a music site. It has totally destroyed much of the used market in that, in many of these things. It has cost a lot of these companies a lot of money. And on top of that, it's a huge compliance issue. So I love this for Venmo, for PayPal, for Etsy, all of the companies that are going to benefit from this. This is an absolutely fantastic, fantastic thing. Then you have the accelerated depreciation. In general, for property acquired and placed in service after January 19th, 2025 and before January 1st of 2030, the bonus depreciation is 100%. Also, Section 179, expensing of business assets is increased to $2.5 million to $4 million before adjusted for inflation. Awesome. Love it. This one, it's not sure I like this one because it is a stealth tax increase on high earners by capping how much they benefit from deductions. Again, the government wants you to have deductions, but they don't want you to utilize them. That's the way it works. You can have some, but you can't have too many, or that's just not fair. You can use the law, but if you follow the law too much, then we're going to penalize you. Itemized deductions will be reduced by 2/37. That's roughly about 5%, or the lesser of your total itemized deduction, or the amount which your taxable income plus itemized deductions exceed the 37% bracket threshold. So really, unless you are in the 37% tax bracket, in which case you're probably not doing your taxes, you have an accountant, as you should. This isn't going. It's gonna cut the deductions down somewhat. From the math that I've looked at, it's not terrible. It amounts to about a $2,000 increase, probably, in taxes. It's not terrible, but it's not exactly. And that would be somebody who's just barely at the 37% bracket, about $2,000. So it's not the end of the world by any means, but it is, I guess it'll do something. Charitable deductions for not itemizing. A charitable deduction of $150 or $300 for joint returns would be allowed for 2025 through 2028. That's the old church service deduction. Approximately 90% of people take the standard deduction, which is why when we talk about deductions, it's so significant. That any of those changes, so 90% of people who do take the standard deduction and who are over 65 are going to see probably the biggest amount of money back. This would allow people who make those church donations, those small donations each week, this would allow them to deduct that small amount. It just assumes that people give a little bit each year. They want you to be able to have that. I would not be opposed to this one actually being cut out, because I don't think most people even use it for the most part. It's already a relatively small deduction. It's not going to make, it saves you maybe $30. And if you're itemizing your charitable deductions, as opposed to not itemizing it. If you're itemizing your charitable deductions, you're giving large amounts of money. But just adding another $300 deduction for joint returns, no. I think that one could be on the chopping block. Not that it should be, but it probably will be. Here is another one. Another thing holding up the process, and that is terminating the clean energy credits. The following credits would be eliminated in 2025 and 2026, and that is the used electric vehicle credit, the new electric vehicle credit, energy efficient home improvements, and the clean energy system, i.e. solar panels. No more clean energy credits. Now, the clean energy credits were a great way for somebody who did plan on living in their home for the rest of their time. A great way to do a Roth conversion. You could use that tax credit to offset some ordinary income, and you could do a lot of it too. So, unfortunately, that's probably on its way out. Another thing, though, that is not that I'm not going to go too big into detail here, it doesn't look like we'll have time, is that a lot of the green energy credits are also, additional ones, are phased out. However, many of them don't go away until 2031, 2029, and there's even a few that don't go away until 2041. The Republicans are saying that's BS. Get rid of those stupid energy credits. And frankly, if we have to, if that's what it's going to take, fine. But we also need to make sure that we do not, we're probably going to need at least one or two Democrats. So we can't be too aggressive in killing the energy credits. And I'm thinking about this purely from a political play here. That would be the biggest risk. I don't know that those tax credits are going to be phased out any faster, because I think that's the only way that a Democrat could survive voting for a tax cut, is if, hey, those clean energy credits don't just go away immediately. Plus, that would really hurt their fundraising base. Here's a new one. And this is a pretty big provision, and I think it actually, if we're going to find money somewhere, this could be another one. The existing 1.4% excise tax on investment income is replaced with a graduated tax rate based on the endowment size. So that is a tax on private colleges and foundations. With a max rate of 21%, large private foundations will also face excise tax of up to 10% on their investment income. Now look, you ever see one of the sports stars that they all have their own family charities? They're all, the LeBron James Foundation, whatever it is. Those are total, they don't do anything for charity. If we're being honest here, they don't do anything for charity. They are beautiful ways to put your family on payroll, to give everybody a huge chunk of money, and to be able to essentially, it is probably one of the most lucrative things you can do as a very wealthy person. So if you're, making millions and millions and millions of dollars a year, that's something you're going to do. You're going to have a little family foundation where everybody's on the payroll, everybody's making bank, you get to deduct the expenses and so on. I hate to say it, because it's not to say that there's not good ones, but look, family foundations are total horse manure. They totally are. They're total ripoff. That's okay. I have no problem with that. It's their money. They earned it. If they want to start, use the tax law to your advantage, I get it. But I love the idea too of taxing the private colleges, because this is nonsense. Total nonsense. We should tax their endowments. Those things are essentially tax-free. Hedge funds, they never, ever, they have way too much sway, and there's no reason for it at this point. Plus, they're just flooded with cash, of course, because they're not paying anything on it. But universities have lost their way, therefore they get taxed, would be my rationale. All right, I got to take a quick break here, folks. 480-771-7000. Yes, this is an investment show, not a tax show, but I promise you, all of these things are coming. this is going to be what is in the big, beautiful tax bill. There's one more thing we will discuss when we get back. I got to take a hard break. I am investment advisor Sam DeGreen on News Talk 550 KFYI.
Hi, it's Garrett Lewis. Now, what's the biggest mistake you can make when selling your home? Settling for less money, right? That never happens with Orchard. Disappointing offers can wear you down, causing you to settle for thousands less. You don't have to settle when you sell with Orchard. Orchard reinvented the real estate industry by guaranteeing your home sale and helping you sell on the market for top dollar. First, Orchard gives you cash up front so you can buy and move into your new home first on your timeline. There's no waiting, no showings, no double moves. Then, once you're all settled in, your Orchard agent helps sell your home on market for top dollar. One Orchard customer said, quote, "I never could have sold without Orchard. I made way more than I expected, and it could not have been easier." With Orchard, you never have to settle for less. Buy before you sell and get top dollar for your home with Orchard. Curious how much your home's worth? Well, visit Orchard.com to get your free home valuation. That's Orchard.com.
This report is sponsored by Discover.
Loop 101 Pima Freeway eastbound off-ramp to Scottsdale Road. That crash has been moved off left. We have a vehicle fire on the Loop 202 South Mountain Freeway southbound, just south of Buckeye Road to watch out for. And an injury accident involving a pedestrian on Val Vista Drive just north of Williamsfield Road. Now, if you have a traffic tip, call 602-374-6300.
Guess what? Discover's accepted at 99% of places that take credit cards nationwide. You heard right, 99.
All right. Welcome back, folks. Welcome back. I am investment advisor Sam DeGreen. Hey, this is going to be a hello, goodbye segment. We only got, I believe, 2 or 3 minutes here. There's one last thing that is in this big, beautiful bill. And I'm sure many of you were waiting with bated breath, and that is the estate and gift tax exemptions. Woohoo! Those are going to be permanent, as they should be. There shouldn't ever even be an estate tax, but I'm preaching to the choir here. The estate and gift tax exemption will increase from $13.9 million in 2025 to $15 million. So for those married filing jointly, that's about a $30 million estate exemption amount. So it's not going to be a huge thing for most people. The problem is when it does come into play, it is an absolutely brutal thing because it takes what I believe the rate is something like 40 some odd percent. Nothing you can't get around without a family foundation or, some other ways around it. But either way. So that is going to be a very positive thing. The new proposal makes the base exemption amount permanent by removing the expiration date as it should. So there it is. Those are the 18 major provisions that I found. And I think those are the ones that we're going to end up seeing. Now, could the numbers be tweaked a little bit? Yeah, I think they will. Perhaps some of the smaller stuff, the collection plate charitable deduction that most people really, I think you already can take. It's such a small amount. I don't know that it would actually be that beneficial. But again, anything we can do to let people keep their money. The biggest one, though, they didn't give you no tax on Social Security, but they did give people who are age 65 and older a $4,000 deduction because you exist. That is why you get a deduction. Not because you're on Social Security, but because you are Social Security age. So that's essentially what that is. And that is not an insignificant deduction. It's $4,000 per person. 8,000 married filing jointly. So again, Trump pretty much gave everything he promised. Awesome. Now, folks, I know this is an investment show, and we didn't really talk much about markets, and that's because markets are doing well. But the fact remains, there is still plenty of opportunity out there in the markets. Just because things are recovering does not mean we are out of the woods yet. Things can still happen, and they will still happen. We still have trade negotiations ongoing. While this show is for everybody, Our investment program is limited to those with a portfolio of at least $500,000 if you qualify. 480-771-7000. That's 480-771-7000. You can also visit our website, DeGreenPrivateWealth.com. And on that beautiful website, you can listen to all of our most recent past shows and fill out our contact form there. I will talk to you next week, and we will discuss markets. I am investment advisor Sam DeGreen on Newstalk 550 KFYI. This hour was proudly sponsored by DeGreen Private Wealth in Scottsdale.
Transform your kitchen with Sub-Zero Wolf and Cove appliances at Spencer's, Arizona's largest Sub-Zero Wolf and Cove dealer. During their full suite savings event going on through Memorial Day, receive up to a $2,500 rebate on qualifying packages. Meticulously crafted appliances achieve a higher standard of performance, dependability, and style. Enhance every meal while turning your kitchen into a reality. Spencer's, it's like having a friend in the luxury appliance business. 11 value locations, Spencer'sTV.com.
The Maricopa County Home and Flower Show has the best contractors.